In the autumn of 1890, the British Empire came within inches of financial collapse, not from war, rebellion, or politics, but from a failed investment. A single private bank, deeply entangled in foreign debt, almost brought down the world's largest empire. Its name? Barings Brothers. Known simply as the sixth great power after Britain, France, Germany, Russia, and the United States. This wasn't just a bank, it was a cornerstone of the imperial system, a hidden channel through which capital flowed, from London to Buenos Aires, from Cairo to Calcutta. But something went wrong. Argentina defaulted. Credit evaporated. Barings couldn't cover its liabilities, and the entire city of London, the beating heart of global finance, began to seize up. Now imagine the British Empire at the height of its power staring into a liquidity abyss, not because of a naval defeat, but because a handful of overextended bankers misunderstood risk in South America. Here's the paradox. The empire that prided itself on prudence, rules, and calculation had placed its fate in speculative capital flows. Why? Because empires don't just run on armies and laws. They run on confidence, on the belief that debts will be paid, contracts honored, and money returned, with interest. Barings had overstepped, but they weren't alone. They were simply the first domino. Behind them stood the Bank of England. To understand how a single merchant bank could threaten the financial foundations of the British Empire, we have to begin in the second half of the 19th century, when London didn't just lead the world, it bankrolled it. This was the age of sterling supremacy. By the 1880s, the British pound wasn't just a currency, it was a standard of trust, accepted in every port and exchange from Shanghai to Sao Paulo. British banks controlled roughly 60% of the world's foreign investment. More than any military fleet or colonial charter, this was the empire's real leverage, a global web of credit, insurance, and remittances that connected industries and empires through invisible threads. At the center of this web stood the City of London, not the British government, not even the Bank of England, but private institutions, merchant banks, insurance syndicates, shipping underwriters, acting not as national agents but global speculators. Among them, Barings Brothers was the crown jewel. Founded in 1762, Barings was old money, conservative in image but bold in ambition. It financed the Louisiana Purchase, it backed European wars, and by the late 1800s it had become one of the most prestigious names in global finance. But prestige doesn't guarantee caution. The system they operated in, called gentlemanly capitalism, was informal, exclusive, and deeply reliant on personal trust. Few regulations, fewer audits. Deals were made over letters, telegrams, and dinners. This wasn't a modern financial bureaucracy. It was a club. And this club had one obsession: yield. British investors, flush with capital from industrial profits and colonial trade, were desperate for returns. But domestic rates were low. Railways had matured. So attention turned outward, to Latin America, Eastern Europe, the Ottoman world. Economies with higher risk and higher promised returns. Argentina stood out. Between 1880 and 1890, it became a symbol of New World promise. Vast pampas lands, booming meat exports, a growing European immigrant population, and above all, a government eager to borrow. British banks, led by Barings, poured money in. Bonds, infrastructure loans, railway concessions. By 1888, Argentina was the single largest recipient of British capital outside the empire itself. It looked like a bet on growth, but it was a bet on political stability, and that was the problem. While British capital saw Argentina as a rising economic partner, it overlooked the fragility beneath: a volatile political class, opaque accounting, a ballooning trade deficit. By 1889, signs of strain were clear. Argentine debt had doubled in just a few years. Inflation was creeping in, but optimism held. Why? Because the assumptions ran deeper than numbers. There was a widespread belief that global finance had become immune to collapse, that London's underwriting power could absorb shocks, that capital, like empire, flowed in only one direction, outward. Some historians call this the illusion of invulnerability. Others, a faith-based economics. Whatever the term, the logic was clear. The empire would always remain solvent, because it had to. To admit weakness in credit was to admit weakness in rule, and that's where the risk multiplied. Because when confidence becomes mandatory, doubt becomes taboo. Barings and its peers didn't just lend money, they exported belief. But belief, like credit, is a limited resource. Once it starts to dry up, systems unravel quickly. The firm held over £21 million in Argentine securities, nearly half its total capital exposure. It had not only underwritten a major tranche of Argentine government bonds, but also acted as financier and promoter of provincial loans, infrastructure projects, and speculative railways. There were fees, there were commissions, and there was the illusion of control. But underneath this mountain of credit lay a critical flaw: maturity mismatch. The debts were long-term. The liabilities, the demands from investors, the bonds due, the cash flows expected, were short-term. Barings needed continuous capital inflow to cover outgoing commitments. As long as optimism lasted, the engine ran. But if sentiment shifted, liquidity would vanish, instantly. That shift came in June 1890. In Buenos Aires, President Miguel Juárez Celman faced mounting opposition. Corruption scandals, economic hardship, and popular discontent coalesced into what became known as the Revolución del Parque. The rebellion didn't topple the government, but it struck at the core assumption behind Barings' exposure: political continuity. Suddenly, the narrative broke. Bond prices tumbled. Currency reserves drained. Investors began dumping Argentine paper on London markets. The gold standard, meant to anchor trust, now accelerated capital flight. Argentina was bleeding reserves to defend its peso. By July, it was clear: default was a real possibility. In London, Barings tried to stay calm, but the market was moving faster than they could respond. The firm's balance sheet had been built on the premise that its Argentine assets could be sold or refinanced. Now they were frozen, illiquid, unsellable, toxic. And then came the moment of reckoning. In October 1890, the Argentine government formally suspended payments on its foreign debt. Overnight, Barings' holdings became dead weight. Worse, many of the bonds had been guaranteed by Barings itself. Investors weren't just looking at the Argentine government, they were looking at Barings, and they wanted their money back. The firm couldn't meet the calls. Its cash reserves were inadequate, lines of credit dried up. The partners, still operating under unlimited liability, were now personally exposed. Bankruptcy was not theoretical. It was days away. But here's the twist. Barings was not alone. Behind the scenes, several other banks had used Barings as a lead underwriter. Pension funds, insurance companies, railway trusts, even branches of the British state had indirect exposure through Barings placements. A collapse wouldn't just destroy one bank, it would ignite a chain reaction. The Bank of England saw it coming. Governor William Litterdale acted swiftly. Quietly, he began assembling a secret rescue fund, not from the state, but from the private sector. Rothschilds, Morgans, Schroders. The elite circle of merchant capital came together to save one of their own. By November, a £17 million guarantee fund had been pledged. Barings would be split. A good bank would continue operations under supervision. A bad bank would hold the toxic Argentine assets to be worked down over years. The empire exhaled, barely. And here is where the true problem reveals itself. This was not a market event. It was a systemic contradiction. A global financial empire built on private leverage, minimal oversight, and maximal optimism, sustained by the assumption that bad bets simply couldn't happen at the top. But they did. Barings had taken the logic of empire, expansion, extraction, belief in endless growth, and applied it to credit. And when that logic broke, it almost took the entire financial system with it. The British government did not intervene directly. It didn't need to. The system had evolved its own defense mechanism, collective self-rescue. But that's the deeper insight. In 1890, the empire didn't save Barings. Barings revealed how close the empire was to needing saving. To understand why Barings nearly collapsed, and why the entire British financial system trembled with it, we need to look beyond Argentina. The real vulnerability wasn't geography, it was structure. The mechanism was deceptively simple. British investors, seeking higher returns, bought foreign debt. Merchant banks like Barings acted as intermediaries, packaging, underwriting, and promoting overseas loans to clients in London and across Europe. These banks weren't just middlemen, they provided reputational cover. When Barings endorsed a bond, it was seen as sound, not because of data, but because of trust. But trust isn't a metric, it's a belief system. Here's how it worked. When Argentina wanted capital to build railways, expand ports, or stabilize its budget, it didn't go directly to the London Stock Exchange. It went to Barings. The bank would negotiate the loan, typically in sterling. It would then underwrite the issuance, meaning it guaranteed the sale of bonds to the public at a fixed price. If the public refused to buy, Barings still had to purchase the unsold portion. That's the risk. And in the 1880s, they took it, again and again, on increasingly speculative terms. Why? Because the margins were irresistible. Underwriting fees could reach 3 to 5%. On large sovereign loans, that meant hundreds of thousands of pounds per deal. Repeat that several times a year across multiple markets, and you had a machine printing profits. But here's the flaw. Barings didn't just underwrite. It often held the bonds, or distributed them through affiliates who were themselves highly exposed. The risk didn't disappear. It just moved around the balance sheet. Argentina's failure wasn't an isolated shock. It pulled a thread running through pension funds, insurance pools, and bank reserves. There was no central clearinghouse, no deposit insurance, no coordinated oversight. Each institution assumed that others had done the due diligence, but no one truly had. Barings had become a central node in a decentralized system, and it had quietly concentrated the risk of an entire continent's debt. And then came leverage. To secure more deals, Barings used short-term borrowing, often overnight, to finance long-term bond positions. The logic was seductive. If bond prices stayed stable, the spread between funding cost and yield generated safe, recurring income. But when Argentine bonds began falling, lenders pulled back. The collateral weakened. Suddenly, Barings had to post more security or sell assets into a falling market. It's a familiar mechanism now. Margin calls, liquidity spiral, contagion. But in 1890, this wasn't theory. It was happening live, in an era with no circuit breakers, no backstops, and no formal state support. The Bank of England, still technically a private institution, had limited reserves. Its gold stock couldn't absorb a full-scale banking collapse. If confidence broke, the pound sterling, the pillar of global finance, could lose its convertibility. The domino effect wasn't metaphorical. It was mechanical. That's why the rescue wasn't ideological. It was existential. To prevent a run on the banking system, the Bank of England quietly summoned the city's elite. Private capital would bail out private risk, not out of generosity, but to save itself. The Barings mechanism was a mirror. It reflected the deeper fragility of a financial empire built not on capital, but circulation. Money had to move. Belief had to persist. And when either stopped, the entire system shook. Because the empire didn't collapse from the outside, it cracked from within the ledger. The immediate crisis was contained, but the aftershocks were profound. Barings Brothers, once the symbol of imperial finance, was dismantled. The original partnership was dissolved. A new entity, Barings Brothers & Co. Limited, was created under close supervision. The old partners, once among the wealthiest men in Britain, lost everything. Personal liability meant just that: houses, estates, reputations. But this wasn't just a fall from grace. It was a message to the entire financial elite. For the first time in the city's history, it became clear that credibility could not protect you from exposure. That prestige was not a hedge against misjudgment. Confidence had limits. And now, everyone knew where they were. The rescue fund, assembled by the Bank of England, had worked. £17 million, raised in secret, deployed in silence. There was no public scandal, no parliamentary debate, just a quiet acknowledgement that the system had nearly stopped breathing. But behind that calm was a growing awareness. Something fundamental had changed. In the months that followed, credit contracted across the city. Risk appetite evaporated. Foreign lending slowed to a crawl. Several merchant banks, less exposed than Barings but equally over-leveraged, began quietly winding down their overseas portfolios. Argentina paid the price. Its economy collapsed into depression. The currency fell. Capital fled. The middle class, the ones who had borrowed in sterling, invested in railways, traded in London markets, were wiped out. Entire cities ground to a halt. It would take over a decade for recovery to begin. But Argentina wasn't the only casualty. British investors, burned by losses and shaken by doubt, turned inward. The great age of foreign lending paused. Between 1890 and 1895, British capital exports fell by nearly 40%. Colonial projects were delayed, infrastructure bonds went unsold. Even the Suez Canal Company, a blue-chip imperial asset, saw its share prices slump as liquidity dried up. The invisible empire of credit had shrunk, and with it, British influence. Because financial power isn't just about the money sent. It's about the expectation that more will follow. Once that expectation weakens, so does leverage. Diplomatic, political, commercial. The Barings crisis didn't collapse the empire, but it recalibrated its trajectory. More caution, more scrutiny, and, slowly, more regulation. The Bank of England, having seen how close the edge really was, began informal monitoring of major banks' foreign exposure. Nothing was codified, but the myth of perfect judgment had been broken. Behind closed doors, central bankers began to whisper the unthinkable, that systemic risk was real and homegrown. In time, the very structure of finance would begin to change. Smaller banks, too vulnerable to external shocks, either merged or disappeared. Larger institutions grew more risk-averse, consolidating influence. The result was concentration, fewer banks holding more power. And with that power came a new logic, that some were now too interconnected to fail. Sound familiar? Here's the deeper point. The consequences weren't visible in headlines. They were structural, behavioral, psychological. Barings didn't just go under. It pulled the curtain back. It revealed that global finance, for all its models and metrics, still ran on trust, instinct, and leverage. That the empire's economy was not a fortress, but a circulatory system. And that a blockage in one artery, in this case Argentine bonds, could cause a seizure at the heart. The long-term effect was subtle but enduring. More caution didn't mean less speculation, it just meant quieter speculation. Risk didn't disappear, it changed shape, moved offshore, found new disguises, and as always, it waited for the next belief to overreach. Because every empire has its Barings moment. The instant it realizes that the greatest danger isn't rebellion, invasion, or collapse, it's overconfidence with a balance sheet. The collapse of Barings in 1890 didn't destroy the British Empire, but it revealed its inner mechanics and its core vulnerability, dependence on private credit, global flows, and unchecked optimism. Now look at today. The names have changed, the instruments are more complex, but the mechanism? Strikingly familiar. Then it was called underwriting sovereign debt. Today, it's securitization. Then, merchant banks like Barings sat at the center. Today, it's investment giants, shadow banks, and global asset managers. Then, Argentina was the frontier of growth. Now it's emerging markets, high-yield credit, crypto. The surface details differ, but the structure is uncannily similar. Start with the basic assumption, the one that nearly brought the empire down, that major institutions cannot fail, that markets are self-correcting, that someone, somewhere, is always in control. Sound familiar? In 2008, it wasn't Buenos Aires that broke the chain. It was the U.S. subprime mortgage market, but the logic was the same. Risk had been sliced, packaged, resold. Exposure was fragmented, hidden, mispriced. And belief held it all together, until it didn't. Like Barings, Lehman Brothers was a prestigious name, and like Barings, it over-leveraged itself on the back of misjudged assumptions. Lehman wasn't rescued. The system was. And here's where the echo deepens. In 1890, the Bank of England assembled a private rescue, not to save one firm, but to prevent systemic collapse. In 2008, central banks across the world did the same, on a far larger scale, and this time with public money. The actors had changed, the backstop had changed, but the fear, identical. A loss of confidence, a freeze in credit, a global cascade. And just like in 1890, the response wasn't just economic, it was psychological. The phrase, too big to fail, entered the modern vocabulary, but its logic is older. In fact, it's imperial. The moment institutions become structurally essential, their survival becomes non-negotiable. Not because of their morality, but because of their position. They are no longer market participants. They are load-bearing pillars. And here's the paradox. The more we try to insulate them from collapse, the more risk concentrates beneath them. That's the pattern. In 1890, risk was hidden in sovereign bonds. In 2008, it was hidden in mortgage-backed securities. Today, it hides in new places: private credit, leveraged ETFs, derivatives built on borrowed volatility. And once again, it's the illusion of diversification that enables the buildup. In both centuries, the financial system believed it had become immune to collapse. The British thought empire guaranteed solvency. We think technology, data, and monetary policy will prevent another crash. But history suggests otherwise. What history shows us is that financial systems do not collapse from unfamiliar threats. They collapse from familiar ones that have been renamed, restructured, and re-legitimized, just enough to pass unnoticed. Then it was called overexposure to Argentina. Now it's yield-seeking behavior in high-risk assets. Then a private bank misjudged political risk abroad. Now, entire portfolios are built on algorithms that can't model political will, social unrest, or ecological collapse. And again, the belief persists that someone is watching, that someone knows. But in complex systems, knowledge is always partial. Oversight is always delayed. And the moment of recognition always comes too late, just like it did in 1890. So where are we now? Global debt is at record highs. Capital moves faster than ever. And trust in currencies, in markets, in central banks is once again the fragile glue holding everything together. And still, we behave as though belief itself is a safeguard. It isn't. Belief, like leverage, magnifies both growth and collapse. It can sustain momentum, but once it breaks, systems don't decline gradually. They snap. Which brings us full circle. Barings didn't fail because of one bad investment. It failed because the system around it needed it to be infallible and ignored the warnings when it wasn't. Today's markets are more connected, more digital, more opaque, but they're built on the same principle: circulation. Money must flow, confidence must hold, and risk, real risk, must be kept out of view. Until it isn't. And when that moment comes, it won't look new. It will look familiar. Barings was saved, but the world it exposed couldn't be unlearned. It showed that empires, even financial ones, are not solid structures. They are systems of circulation, built on belief, bound by contracts, and vulnerable at the joints. It showed that the greatest power often lies not in armies or flags, but in institutions that no one elected, yet everyone depends on. It showed that collapse doesn't announce itself. It comes in silence, under the weight of familiar names and ordinary decisions. And perhaps most importantly, it showed that once a system learns how to survive collapse, it doesn't necessarily reform. It evolves. Today's financial world speaks a new language: derivatives, collateralized debt, algorithmic trading. But beneath the surface, the same impulse persists: to stretch the invisible thread of trust until it holds more than it safely can. Every generation thinks its system is different, more sophisticated, more stable, more watched. But history doesn't repeat, it waits. And when belief overreaches, it simply changes form.